Good afternoon, it's 1 o'clock, Friday the 13th of November. It's the Wall Street Crossover Show sponsored by Admiral Markets and co-presented with by Darren Sinden, who's a market commentator at Admiral Markets. Good afternoon, Darren.
Afternoon, Zach.
Well, it's a bit of a mouthful all of a sudden, actually, with the Friday the 13th and everything else. I was trying to scare people there. But I think probably just seeing me on the screen is enough for that. We're in the run-up to retail sales this afternoon in the US.
Yeah, it was a relatively quiet week in the US, but as you say, retail sales data and PPI and University of Michigan to come. So some stuff to get your teeth into this afternoon.
But the market turned rather weak for some reason.
Well, we talked about this on Monday and again on Tuesday when the future for equities is probably on the downside path as and when the Fed raises rates. So there's been one or two notes about that this week, and certain sectors may perform well, certain sectors may not. My own personal belief is that the end of free money is probably something of an issue for many firms, and of course buybacks and special dividends and things may come to an end because perhaps they won't be able to raise debt so cheaply in the markets when US rates are running a bit higher. A lot will depend on how quickly the Fed raises, though, and that's obviously is the subject of some debate.
And you don't have to be a Harvard graduate to work out that in a time of deflation and rising interest rates, it's not going to be a great time for stocks either, is it really? No,
I mean, if you set it out in those terms, theoretically, no, it shouldn't be.
Right. Okay. Well, let's look at the slides and the information you brought to us today.
Okay. Well, one or two points of interest this morning in Europe. First of all, we had GDP data from across the continent, but I've just picked out what I see as the two principal numbers. First of all, GDP for Q3 for Germany came in bang in line at plus 1.8%. Exactly what people were expecting, though that is weaker on trend if you look at it in that respect, but it's not out of line with economists' forecasts. And then for the wider Eurozone, we did have a miss. Q3 GDP here coming in at plus 1.6% versus the forecast of a gain of at least plus 1.7%. So worrying again for the ECB, and that to some extent has been compounded by a Spanish harmonised index of consumer prices. This is the number that the ECB, or the measure of inflation that the ECB prefers, I should say, to focus on. October's number, and this is on a year-on-year basis, and minus 0.9%. Again, bang in line with the forecast of minus 0.9%, but again in deflationary territory. So as we'll see with it, we look at a chart at the end, whatever the ECB is doing, it's not doing it well enough, and it's not working.
Well, and there's also the theory that it's actually the wrong policy anyway,
that's
given
also very true.
The experience of the last 7 years everywhere that the policy has been done. Okay, so next week?
Okay, well, it's quite a busy calendar next week. We start with some equally important data from Consumer Price Index for October for the whole of the Eurozone. So we get a read on inflation across the whole 27 member states. Then we get Italy's trade balance on Tuesday. Again, it'd be interesting to see how they fare, how their economy is moving and shaking, as it were. UK PPI and CPI, so the double whammy of inflation data on Tuesday as well, here for the UK. Tuesday also sees the release of the ZEW surveys for Germany and the Eurozone. So we get the current conditions index there and the look ahead. So just really what investors are thinking, their sentiment towards conditions now and to the future. And then amongst the other items next week, UK retail sales for October released on Thursday. Retail sales obviously taking on more and more importance in developing economies, or other developed economies, I should say, because the consumer is and the service side of the economy is so important to the recovery.
Okay, right. So that's the backdrop. Let's go on to the movers.
Okay. Well, a company that can't ever seem to put a foot right of late is Group 4 Security, GFS PLC, and they've been downgraded today at Royal Bank of Canada, trading at 224.2p, down around 5% this morning. RBC is quite scathing in their note. They say there are significant challenges ahead, and sort of in complete contrast to the management's upbeat assessment. So they've downgraded the company to underperform. They've cut their price target to £2.10 from £2.30. They forecast a 6% cut in earnings per share in 2016, and they downgrade their EBITDA forecast for the company by 24% as well. So, or at least they say that that's an implied downgrade of 24%. So. A tough day for GFS, but it seems to me that lots of the problems they've had in the past have been of their own making, so it's up to them to turn it around. And then Just Eat, recent IPO in London, a stock that makes its living delivering takeaway food from a variety of local restaurants. 423.4. They were trading in pennies today, down 2.28%. Market chatter suggested that online giant Amazon is muscling in and signing up UK takeaways for a rival service. And they had a sharp move last week as well. And it struck me then that that was probably the reason, although that wasn't the story that was dragged up at the time. But obviously, if Amazon or Google were to take a look at that space, it could well be curtains for Just Eat.
That might explain why I think when the company came to market, there was a lot of hedge funds shorting interest. Presumably, some people just worked out that there's just there's not really any barrier to entry in terms of this alleged business, and this may be proving them right.
Quite possibly, yeah.
Right, okay, well, let's go on to the M&A.
Okay, well, we're back to look at a company we can't seem to leave alone over the course of the summer and the autumn, which is Syngenta in Switzerland. SYNN, the ticker there in Zurich. 370 Swiss francs trading this morning, up 6.97%. And once again, the Swiss agri-chemicals company is in the sights of a buyer. This time, it's rejected a bid from China's China National Chemical Corp, or China Chemi, as it's known for short. The Chinese have said to have offered around $42 billion US, or the equivalent of 449 Swiss francs per share. Obviously, a significant premium to the current Syngenta price, but the offer, even though it's substantial, is still well below the $47 billion that was on the table from Monsanto, which was equivalent of 470 Swiss francs. That was on the table, as I say, until they walked away at the end of August, beginning of September. So I think if any deal is to proceed, then certainly a higher price is likely to be required. If the Chinese can get Syngenta to agree to the proposals, it will become the biggest takeover by a Chinese company in Europe in history. But of course, the idea of a Chinese company, a state-owned one, buying a Swiss, I should say, a Swiss gem of a company, can we put it like that? So it might well prove to be an anathema to the very conservative Swiss, and so any talks are going to obviously involve a political dimension as well as any competition concerns. We noted last week, of course, that both Dow Chemical and DuPont in the US are considering their options in the sector. So a counter offer is not completely out of the question, or perhaps an alternative combination that could be on the cards as well. So the space is certainly very fluid, and this is probably not the last that we'll hear of Syngenta, or indeed the consolidation in the agrochemicals business.
Well, I'm sure if the Chinese offered 50 billion plus or something like that, all those concerns in Switzerland, political concerns, might melt away. A low ball bid doesn't help anybody, doesn't it? No. Okay, on to the data points.
Okay, well, as you alluded to at the beginning of the show, we have retail sales for October in the US. They're forecast at plus 0.3% against the prior plus 0.1%. It's been very patchy for retail sales throughout 2015, and no real clear direction. And the same really is true of the other data point today. PPI, Producer Price Index for October, has been drifting possibly more to the downside than the up. Forecast for today's number is a modest gain of plus 0.2% against the prior loss of minus 0.5. Any kind of positive move, I suppose, is would suit the interest rate hawks. A weaker number plays to the hands of the dubs. Well, as we know, the Fed Fund futures are still saying a 66% chance of a rate rise in December, so it'd have to be a terrible number to see that probability dislodged significantly. And then if we move on to what's on the table for next week, CPI on Tuesday, so further inflation data to come then, alongside the industrial production numbers for October as well. We have housing starts data on Wednesday, as well as the FOMC minutes. I don't think that will contain any great surprises, but as ever, they'll be poured over for any nuances. Probably though, with 6 Fed governors speaking yesterday, that their thoughts on the matter is probably well and truly out in the open. And we've got the data-rich Philly Fed survey on Thursday to look forward to.
Right, and the pre-market movers and levels.
Okay, so we start with Cisco Systems, ticker CSCO in the US, $26.40, pre-market down around 5%. They reported after the close last night they beat on EPS and they beat estimates by 3 cents, but unfortunately the guidance is light, and that guidance has disappointed the market. You may remember that they were all over the press earlier in the week announcing a partnership with their Swedish rivals Ericsson, and they certainly spun that story as one of positivity and combined together in a position of strength. But given the lighter guidance, you might feel that maybe that's a move that was forced upon them rather than done by choice. And then a slightly happier story with the company Illumina, ticker ILMN in the US, $162.75, up around 4.75%. Illumina is a genetics testing company. They're going to join the S&P 500 index, and they'll replace Sigma Aldrich, which is stepping out as they've been taken over by Merck. So always good news when a company gets promoted to a blue chip index, and obviously tracker funds will be upping their weighting, etc., to bring them into line.
Right, okay, on to the levels to watch. Sort of a grim day. Well, grim day yesterday and pretty grim today as well.
Yes, no real incentive to get involved today unless you're on the short side. You say European equities certainly drifted lower. FTSE now, we're watching 6100 again on the downside, and we're not too far away from that as we speak, and playing 6180 to the upside. It seems unlikely, though, that the upside level will be challenged today. In the DAX, we're back down to 10,720 on the downside, plays 10,810 to the upside, moving further away from the 11,000 handle. S&P and the Dow both were substantially weaker last night, so that's the best way to describe it. 2037 now is the downside level to watch, and the S&P plays 2058 to the upside, and those all-time highs receding into the distance to some extent. And for the Dow, we now play 17,400 against 17,490. Again, the risk is clearly to the downside still.
But all these indices, they squeezed the last sort of shorts out after the payroll numbers last week.
Yeah.
Retested those highs, did all sorts of jiggery pokery, and then finally down yesterday. It was quite a like a sort of an extended process of attempting to break higher, failing, and then dancing around resistance. But anyway, we'll see how that works out for next week.
Okay, currency-wise, it's been relatively quiet over the last couple of days, but euro is at 107.51 on the downside against the dollar, plays 108.10 to the upside. The Aussie, a bit better for choice, 71.25 on the downside, plays 71.55 to the upside, managing to stay above that 70 handle. Dollar yen, I'm surprised actually that the yen hasn't weakened further, but it hasn't. 122.52 now is our downside level, plays 123.10, and in cable 151.90, so slightly better than we were at the beginning of the week. It plays 152.40, but no great shakes really.
No big sort of dollar breakthrough either, which
no,
was
the
surprising.
dollar index gave up some of its gains from earlier in the week. So I think, much like equities, the currencies are really looking for an impetus, a new macro cue to tell them which way to move.
Okay, well, let's move on to the in focus section.
Okay, so as we flagged earlier, we've got Eurozone CPI data next week, and the question is, is this showing us a success of QE or otherwise? And I think the answer is otherwise. Despite almost 8 months of ECB QE, we've seen little improvement in GDP or any increase in inflation across the Eurozone. And in fact, GDP has turned lower and inflation has dipped below zero and remains in a downtrend. ECB Chair Mario Draghi warned on risk to the downside to the Eurozone economy when he spoke to the European Parliament earlier in the week. And the chart here, fairly self-explanatory. EU inflation is the blue line. The EU GDP growth rate, or Eurozone GDP growth rate, I should say, is the dotted line. And you can see that whilst we have had a pickup in GDP since mid-2013, we've actually started to see a decline again. And that decline obviously comes when the ECB's pumping 60 billion euros a month into the market, and at the same time, despite an attempt to rally as far as inflation is concerned, we've turned lower again, and indeed remain in a downtrend, which I've annotated here with the dotted red line. So I think the answer will be that there won't be any surprise to the upside in CPI on next week, and we will ultimately hear the ECB doing something sooner or later. So the December meeting is probably the time when they'll announce the plans, what they for extended QE, for a variance of where they're targeting the money, for how much money they're actually pumping into the system. There's another conversation to be had, of course, as to whether that will actually achieve anything, and I think the answer is that
we agree on no, I would suggest.
Yeah, I think we do, because the likelihood is we'll see a diminishing return as we have with Japan. And I think what we need to see is politicians act and use fiscal stimulus and try and get the economy going in the real world, rather than in the vague monetary background.
Darren Sinden, market commentator, Admiral Markets, thanks for your comments today. We will be back on Monday at 1 o'clock. In the meantime, enjoy the weekend.